Well, the S&P 500 up almost to 7% year to date. Part of the reason for the gains you can attribute to better than expected first quarter earnings results. Adam Parker says for the rest of the year, analysts are overly optimistic about profit margin growth. He is the U.S. equity strategist at Morgan Stanley. He is right next to me here in the newsroom. Adam, thanks so much for coming in, talking to us about the markets. You have one of the most bearish targets, actually, on Wall Street right now for the S&P 500, 1238. That's about an 8% drop from where we are now. What is the reason for that? What's the number one reason? The
number one reason is really the market multiple. So if you think about where the market goes, there's earnings and then the price to earnings multiple. You multiply them together, you have your target. My differentiated call is more on the multiple. If growth decelerates, if there's more volatility in growth, it typically means you don't want to pay more for today's earnings, and that's really the contrarian part of our call.
So you do think then that growth is going to slow more than consensus thinks?
I do. I think there's already some signs of it, whether it's in some of the economic data here in the U.S. Morgan Stanley's Q1 GDP tracker was at 4.5% in January. It came down consistently through the first quarter. It's also come down a little in the second quarter. So there's more pressure on a second half of the year rebound now in order for the prices of the stocks to stay where they are.
But that said, I mean, there are a lot of companies reporting productivity gains and saying that they're functioning at a higher level of efficiency than before. They have more cash on the balance sheets. How do you have this contrarian view?
I think the key debate right now in the market is, can the profit margins continue to bifurcate from the economic news? The problem I have is the estimates that the analysts have really accelerate in the second half of this year and next year, and so it's on the profit margins where I think they're going to miss. I'm not saying, hey, margins are high, they're going lower. I just don't think they're going to go up at the rate the analysts embed.
So they've extrapolated too much?
I believe they've extrapolated too much, and that'll cause some more multiple contraction, some more fear to grow.
That said, there's two sectors you like a lot. Healthcare is one, also technology. Why are these two, in general, the best picks?
I think it's because there's lots of cash on the balance sheets. They've never been cheaper ever versus their counterparts. So healthcare's never been cheaper versus staples, another defensive sector. Tech's never been cheaper versus industrials, another offensive sector. So the market's basically telling you these sectors are going to miss or they won't have margin expansion, and I don't think that's the right portfolio strategy here.
All right, and to your point there with that multiple expansion with technology, because we have seen knockout earnings, but you say this is one group where we can see the margins continue to expand.
If you look at what portfolio managers do, they try to figure out where the beta is cheap, and they look at tech often versus industrials and say, if the world gets better, these are two sectors that will work. So I compare those two and I say, well, wow, tech companies have never been cheaper ever versus industrials. Their margins aren't supposed to expand that much more, whereas industrials are supposed to expand a lot. And so as a relative trade, I certainly like tech over industrials here.
All right, tech and healthcare, two sector picks from Adam Parker. Adam, thanks very much, head of U.S. equity strategy at Morgan Stanley.